Hello and welcome to CoronaNomics, brought to you by Econ Films. This week, coronavirus and the markets. Countries around the world are in the midst of the worst ever peacetime recession, with mass unemployment and warnings that global trade could fall by a third this year. In the developed world, stock markets collapsed in February, yet since the end of March they've shown a remarkable recovery. So what's going on? Are investors pricing in a vaccine breakthrough or betting on a V-shaped global recovery? Some argue the disconnect between financial markets and the real economy won't last, that markets have much further to fall. So who's right, and what are the implications for the rest of us? I'm Ben Chu, economics editor of The Independent.
And I'm Lizzy Burden, economics reporter at The Telegraph. We'll be your guides, and if you like what we're doing, please hit like, share and subscribe. This week we're joined by Lord Jim O'Neill, a former UK Treasury Minister and chair of Goldman Sachs Asset Management, where he famously coined the term BRICS. He's currently chair of the Chatham House think tank. We're also joined by Willem Buiter, a visiting professor at Columbia University in New York, a former chief economist at Citigroup, and a founding member of the Bank of England's Monetary Policy Committee. Jim, Willem, welcome both to CoronaNomics.
Very nice to be here. Yeah.
So to set the scene, let's take a look at this chart. Now the green line here shows the US stock market since February, and the orange line shows cumulative new US jobless insurance claims. That's the number of new people claiming out of work benefits every week. So as you can see, from February, the S&P 500 starts to plunge, but in mid-March, the people signing on for welfare starts to soar. At the same time, stock market starts to rise. And now it's technically in a bull market, up 20% from its lows. So first of all, Jim O'Neill, why is there such a disconnect between what's going on in financial markets and what's going on in the real economy?
I wish I knew the answer to that, Ben. 40 years of following markets, I remain as mesmerised and confused about them as always. But I'm also laughing to myself because during my time as chief economist of Goldman Sachs, I presided over and played an active role in the creation of a high-frequency global leading indicator. And amongst the hundreds of variables we tested, one of the things that I recall from it is actually 180 degrees opposite of what you've just explained. That the change in US weekly job claims was actually a really good, oddly, lead indicator of the US stock market. And yet now it seems to be the opposite. And I can only guess that the main reason why this has happened is due to the sheer scale of change of everything, that by the time that statistic was released, people knew that it was going to be so severe and that the rate of change going forward wouldn't be so bad. And actually, in any case, and I sort of slightly kicked myself for not personally thinking of it more than my hunch. It was clear since the start of February, the US stock market in particular, although it's true about others, has essentially been moving in reflection of the rate of change of infection and the vaccine distribution curve. And the reason for the collapse in February and early March is because we then realized the whole of Europe and North America were going to be by this horrible disease. But since the beginning of March, it was quite clear that we were already starting to get to the peak rate of change of infection in places like Italy. And of course, the news about an early vaccine has improved. So within the constructs of markets being markets, I don't think the way markets have behaved is as irrational as I read and hear so many other people thinking about.
And let me ask that you, Willem, do you feel that you can make a case for rational markets here, or do you think maybe we're due a correction?
I can make a case for rational markets. I don't necessarily put my own money on that argument, but markets supposed to take the long view. We could easily have a very sharp, nasty trough in unemployment and GDP without there being a prolonged decline in profits in future years. So yes, and in any case, the S&P index is not a measure of profits current in the US this year. It's a global index. and it is quite unrepresentative in terms of the overweight of tech stocks and medical stocks, health stocks. So I can easily tell a story that markets are nowhere near as bonkers as they look.
Jim O'Neill, we haven't talked about developing economies, financial markets. I mean, is there such a disconnect there, or does that seem less of one?
Before I directly answer you, just to add on to my earlier comment on Willem's, I actually wrote something for Project Syndicate about this a few weeks ago. After 50 years of being so involved in economics and markets as I've been, the equity markets in particular remain as mesmerizing and as fascinating and as difficult as always. And of course, as famously said, 8 times have predicted the past 3 recessions by certain well-known economists. But it is also the case that markets do frequently anticipate things before a lot of the people that are talking about them and talking about economies realize. So I do think, especially in these profoundly complex and such a remarkable time in any of our generation, it's so easy for us to have such strong opinions about anything, but markets are markets. So I don't dismiss out of hand that the markets might understand aspects of this more than many of us that talk about them. With that your question, and I say all of that because it was profound wisdom by the middle of March. It was simply a matter of weeks before there would be utter devastation throughout the whole of the emerging market world and the third world. And actually what we find is a much more nuanced situation with some so-called emerging market countries, Brazil notably, seemingly really struggling badly, but South Africa, at least so far, nothing like what the consensus view might have expected and was confidently predicting. And indeed, Africa in general, for reasons I'm sure none of us really understand yet, has coped okay, as has India. Obviously, large parts of North Asia, which bizarrely are still often regarded as emerging markets, have also coped very well. And linked to some other things I've said it. If you look at some of the countries that have been best prepared for this, like South Korea, their own markets have performed better than many others. I'm often happy to sort of describe what markets are doing as being completely mad, and it could well be that this is completely mad. And certainly, if the recent news on vaccines turns out to be a great hope that fails, then I suspect we will have a further big drop, and it will really hurt a lot of emerging markets. But if what the news we've seen in the past fortnight about vaccines turns out to be right, I think many markets will strengthen a lot further, including many emerging markets, where there is huge fear that it's going to devastate them all, but with some notable big exceptions like Brazil and Russia, and I'm sure others I don't mention, but so far, the biggest devastation here has been confined to North America and Europe, with the exception of Brazil and Russia, so far.
And Willem, if we come back to the UK and the US, you mentioned about a V-shaped recovery. What shape of recovery do you expect? Could it be a U or a W or a sideways J, or what do you think?
I'm expecting a couple of W's. After all, with a name like Willem, you have to go for the W. I want to point out, though, that the impact in the slightly longer term could be quite limited. Total confirmed global cases are just over 5 million now. That is 0.06% of the global population, right? Global death, 328,000, make it 30,000. That is 0.04% of the global population. Right? It is possible, even if you don't find a vaccine, that you'll find a cure that is reasonably effective and will permit the majority of the labor force that can't work at home to go back to work at in places where social distancing is more difficult. So I personally don't believe that a vaccine by the end of the year or early next year is terribly likely, but I'm speaking for, from a position of profound ignorance, which seems to be a defining characteristic of this crisis. Epidemiologists don't seem to be knowing what's going to happen next, so economists are very unlikely to be terribly confident.
And speaking of unusual market behaviour, let's have a look at what happened to oil futures last month. So you can see that prices slumped from $60 a barrel at the start of the year right down into negative territory on the 20th of April, which means traders were willing to pay $40 a barrel to have it taken off their hands. Jim, is the story behind this simply that demand for oil crashed because the world went into lockdown, or is there more to it?
I think that's a large part of it, and actually, again, linked to my sort of ridiculous short-term self-admiration about how I should have been a trader during these markets. I actually have an email dialogue with some old market mates of mine that I thought oil was a really good thing to buy that day, and I think we're up 70% from the following day. But I quickly add, I managed to waste more than 3 years doing a PhD about oil during the second oil price crisis, and about the only thing I learned is trying to forecast oil prices is even dafter than trying to forecast currencies. So with that in mind, the dilemma that oil has had is, of course, this staggering collapse of the world economy and therefore a huge collapse in oil demand. But it came on top of, particularly because of this remarkable rise, rather encouragingly in a way, in 2019 around the world, especially in Europe, about the desire to do something serious about climate change. The pressure on the oil markets was already building substantial in a negative sense anyhow. So you had the perfect storm of everything that could go wrong for oil all coinciding. The recovery suggests to me, linked to the discussion about a V or not a V, that at least for a period, it might feel like a V, because we have almost definitely probably seen the worst of the world economic decline a few weeks ago, at least for the foreseeable future.
Willem, if we are going to see Jim coming out of retirement to become an oil trader, what would you advise him for the long term? How should someone looking to invest in oil invest?
Well, as Jim hinted, it has become much more likely that oil will become a stranded asset earlier than we anticipate. Right? These actions in Europe are supportive of that. I was staggered to see the oil price actually go negative. I'll be teaching that particular incident for years, I hope. But I do think that we are headed for a world where a lot of oil is going to end up being left in the ground.
So, Willem, on the subject of negative prices, we've had some unusual movement and signals coming from the Bank of England lately. They always said they would never do negative interest rates, but now Andrew Bailey, the bank governor, said it's being looked into by the central bank. We've also got Donald Trump in the US. He's been banging the drum for negative rates for some time in his tweets, calling the Federal Reserve boneheads for not doing it already. And more recently saying that negative rates would be a gift for the US economy. Sticking with you for the moment, Willem, what impact do you think the UK and the US going negative in interest rates would have on equity and bond markets?
Well, if we don't take measures to lower the floor, the effective lower bound on interest rates, then we can't cut the policy rate much below minus 75 basis points, and that will be small potatoes. If we do what needs to be done to really lower or preferably abolish the effective lower bound on interest rates, so that we can cut nominal interest rates, the policy rate, to -3, 4, or 5%, then central banks will have serious symmetric additional instruments at their disposal. I hope they will do that. The easy ways of doing it, you basically abolish cash or currency, or at least any note larger than £5 in the UK, or you introduce a variable exchange rate between cash and reserves with the Bank of England, or you can indeed rather clumsily tax currency holdings. I would favor getting rid of cash altogether. It is out of date, out of time means of payment, and giving the central bank the tools to go equally negative as they go positive would be an extremely important increase in its arsenal.
But Willem, what about the practical difficulties with that, given that a lot of people don't have bank accounts? What's the solution from that perspective?
Right, everybody can get free of charge an account guaranteed, not run by the Bank of England, an account operated by banks, building societies, post offices, or whatever. So the technologically deprived generations can still manage to buy their daily meals, but I think just move rapidly, don't take prisoners.
And Jim, what's your view on negative rates? How do you think they would impact the equity and bond markets? Should we welcome it?
This is a great opportunity for a lot of central banks to be given possibly revised mandates. When inflation targeting came into existence, there was quite a bit of discussion for some while about the idea of so-called nominal GDP targeting, and for various practical, also conceptual reasons, it was never really supported by many. I used to have some doubts myself, but I think the environment has become quite worthy of serious consideration, especially where governments award the central banks what their mandate should be. And this would be applicable to the UK. One might argue the US is in some way sort of pursuing some de facto nominal GDP targeting. But I think the environment has come where this is what a lot of central banks should do. It wouldn't guarantee a V-shaped recovery, but it would certainly increase the probability of one.
And you used to be a minister at the Treasury, Jim. How do you think it would be received inside the Treasury, that sort of thinking?
I think it would scare Treasury officials, and certainly those that move between the bank and the Treasury tend to be very cautious by nature, and a lot of people are very proud of what's happened with inflation targeting. But as we've seen now and in 2008, when really big things happen, a lot of conventional economists and the way they think in an inflation targeting type framework aren't really relevant for dealing with the challenge. And I think because we have, in addition, quite a long period of persistent inflation undershooting, I think it is something that should be considered. And I do suspect there are some people around the Treasury that are probably thinking about things like this. And I know from the piece I wrote that somebody in Australia who has a lot of influence on thinking is also now talking about the same thing there and in a number of other places. So I suspect they will be very cautious, and a lot of people are trying to oppose it because thinking that in fact we might end up with inflation as a result of all this policy stimulus. But it's something that I think is much more worthy of consideration than I would have thought a few years ago.
And Willem, let me ask you, you were a founding member of the Monetary Policy Committee. Do you think, from what you know about the Bank of England, that it might be prepared to grasp some of these more radical monetary policies that you've been advocating?
I think that's simply because they will need more instruments to support economic activity, they will look at negative interest rates. I myself am not a supporter of nominal income or nominal GDP targeting, basically because nominal GDP has no welfare dimension. Nobody cares about it intrinsically. Inflation matters and real GDP matters. So I would favor a dual mandate slightly more explicitly than what the bank has at the moment, where you have inflation and real activity measured whichever way you want, GDP, employment, as a dual mandate. Then I would liberate the bank from this artificial constraint on its ability to set interest rates negatively as easily as set them positively.
Willem, how important though is the personality of the governor in terms of actually enforcing these changes? Does it really matter who leads the bank?
No, you need somebody who is smart, articulate, and not afraid. I think Andrew Bailey satisfies these three criteria. I think that comes the hour, comes the person.
Excellent. Well, this has been a really wide-ranging discussion, and thank you both for taking part in it. Thanks to our guests, Jim O'Neill and Willem Buiter, for appearing on CoronaNomics.
We'll be talking to many more top thinkers in the weeks ahead to discuss how we can weather the economic storm of COVID-19. So please do stay tuned and subscribe to our YouTube channel.
And remember, if you like what we're doing, please hit like and share.
And if you'd like to speak to us, just leave us a comment below.
This has been CoronaNomics, brought to you by Econ Films.